Hello, everyone. This is the Free American Press with your host, Alexander Horat. Today, we welcome back Kevin Wadsworth, renowned technical analyst and founder of Northstar and Bad Charts, known for his precise long-term forecasting in gold, silver, and global markets. Hello, Kevin. Thank you for coming back on the show.
Hey, Alexander, how are you doing? It's good to be back. Thanks for inviting me back. It's always good to talk about charts.
Yeah, it's really great you're back on the show, and I'm doing well. And one thing I'd like to talk to you about is gold and silver. So we saw gold and silver recently had a pullback somewhat from its all-time high, but now it's inching closer towards its all-time high. So I want to see where are we right now when it comes to gold and silver.
Yeah, sure. Well, as always, we need a chart to give us some evidence and give us some visuals. So I'll share my screen there, and you should be looking at my gold chart. Okay, right. Well, we clearly broke out very strongly from the $2,000 area, and then we broke out again at around about $2,800 in that kind of region, above a resistance line that goes all the way back to 1980. The price has shot very rapidly to the upside, as he said, and we've been up to around about $5,600. Interestingly, we've got some Fibonacci levels on this chart, and if you don't know much about Fibonacci, it's just a sequence of numbers that crops up all over the place in the natural world and in mathematics. And it's uncanny just how often the price reacts at these Fibonacci levels. You can see historically the price pausing and consolidating at various Fibonacci levels. We're just pushing through an important or reaching an important Fibonacci level here. That the calculation is done based on the low in 2000, the high in 2011, and then the low there in late 2015. From those 3 points, you can extend upwards these resistance levels. And so we've been hitting, pausing, consolidating around this 2.618 Fibonacci extension level. But you can see from the previous bull eras in the 1970s, the 2000s as well, that this extended move of 645% cropped up on both of those previous occasions. And interesting to note that if that was to happen again, it would take us to this top Fibonacci level at around about $8,000. Now, that is perhaps a reasonable target over the next couple of years, let's say. I mean, at the rate we're going up at the moment, of course, we could get there in, in a couple of months. But that first time, I mean, the first thing to say is that regardless of what happens in the short term, in terms of corrections, the time to enter the gold market was either at the breakout at $2,000 or 2,800, that kind of area. If you're looking for an entry now, if you've been ignoring these signals on the chart that we've been covering for the last 6 years, if you've ignored all of that and you're now looking for an entry, well, don't blame me if you end up in a loss-making position as soon as the correction comes along, because the low risk entry point is down here. That's a low risk of finding yourself in a loss-making position when the next major correction comes along. If you enter now, when price has already moved up from 2,000 to $5,500, then it's obviously much more likely that when a correction comes in, you're at least temporarily going to be seeing yourself in a loss-making position. But the market, I think, would save you in this on this occasion, because I don't expect that we're going to be moving into a longer term bear market anytime soon. And you can probably see from these two target boxes that we have that initial target area up around $8,000 plus, and then later in the bull era, a target box up in the region of, well, perhaps at the moment we're estimating $16,000, and that target is way off into the future. So we'll adjust that secondary target as and when the evidence comes in. But one thing to point out is that the capital rotation process is what's powering the gold bull era. And the capital rotation process is when all of these different instruments move into a bear market priced in gold. We've mentioned this before, and US money supply, the US dollar index, CPI, PPI, all of these things are in a bear market priced in gold, and that's what gives us the sort of confidence, I suppose you could say, to suggest that this gold bull era is really only just starting rather than approaching any kind of an end point. The three previous occasions when all of these boxes turned red was in the capital rotation events of the sort of early, and we know exactly what happened to precious metals, commodities, energy, and oil on those three previous occasions. They all went nuts over a period of 10, 15 years, whilst the stock market kind of went pretty much nowhere. So that is the backdrop to all of this. And if we look at it in terms of the Dow Jones, for example, priced in gold, that was one of those boxes in that table. It was colored red because we're in a, the Dow Jones is in a bear market priced in gold. You can see the previous occasions when that happened. If I go back far enough, you can see that occasion in 1930, 1929, 1930. It plunged something like 80% or more. And it wasn't until 1950, what, 1958 that it got back to the previous high. So it spent, 20, best part of a quarter of a century getting back to where it was previously. Um, so that's the Dow Jones priced in gold. So during this entire period, gold massively outperformed the Dow Jones. The next occasion was the 1970s, as I mentioned. That was the next capital rotation event. The chart plunged, and between sort of 19, well, the whole process actually began back in the 1960s and culminated in this huge plunge in the 1970s. And that's the Dow Jones massively underperforming gold. The Dow Jones fell, gold went up by multiples, and silver, commodities, energy, and oil. And then, the next period, we had another capital rotation event down here, but it was rotating in favor of the stock market. So that rotation took place away from precious metals towards the stock market. And then in the early 2000s, we saw the next rotation take place away from the stock market towards precious metals. And when this chart breaks down below this green line and this green splodge, that means that we've got increasing evidence that we're in a bear market environment for this chart. Bear market environment for this chart means that gold is beating the Dow Jones, and that happened between 2000 and 2011, and gold doubled, and then it doubled again, and then it doubled again. So it went up by hundreds of percent, and silver went up by, yeah, massive amount. I think it went from about $4 to almost $50. So huge, 1,000% gain. Then we had another little rotation away from gold towards stock markets, but it didn't really take us very far before it rolled over again. It hit major resistance, and now we're plunging again, having broken below major support here. So this is suggesting that we're entering a new era of gold outperforming the stock markets. So again, that's one of the pieces of evidence that leads us to suspect that this process is likely to continue for the next, let's say, 5 to 10 years, not 5 to 10 months. Um, so, regardless of whatever correction comes along, this is suggesting to us that we're on a much longer road, a much longer path. Now, if you didn't take that position in gold back here when it was $2,000, and the same thing for silver. This is the silver chart here. If you didn't take that position in silver when we were suggesting you should, which was all the way back down here when it broke out near $28, and then it moved up to the $50 area, and then it broke out again and moved all the way up to $120. You can see the wick on that candle there is at $120. If you didn't take a position there, then I wouldn't have said that now is the ideal time to take a position. I mean, long term, if you're a stacker, then fine, just dollar cost average, take your position. You won't care if you're a stacker or a very long term investor. You don't care if you enter at $85 and the price drops all the way back down to $55. You're not bothered because you're investing over a 10-year time frame. That's fine. If you're trying to trade this and you want to be in and out in 12 months, then this isn't an ideal time to enter, because we could very well be still in the developing stages of a correction. We may well not get back above $120. We may well continue this corrective phase, eventually tagging the area below $60 before advancing higher. Regardless of any of that, the longer term target is way up here at sort of $300, $400, $500, multiples higher than where we are at the moment. precisely because of all of the evidence that I've just been talking about. But if you didn't take a position in any, in gold or silver, then what should you do? Well, my advice is that, and I'm just going to sort of move to a different chart here. You want to be looking for a setup, Alexander, where you have a long base, a big basing pattern. And if you look at the distance from moving average, let me just put the distance from moving average on here, the indicator at the bottom there. You want the time to enter is when the distance from the moving average is low, not when it's high, because when it's high, as it was in 1980, 1973, and 2011, you were close to a top. Well, look where the distance from moving average is now. It's not low, it's quite high. So it's not the perfect time to take an entry. So look for a market that has been going nowhere for quite a period of time. So with that in mind, we're going to take a look at the oil chart. Let me just find the oil chart. That'd be useful because I've got so many different charts in my list here, but it's down here somewhere. Let's scroll down. Here we go. West Texas Oil. Okay. So what have we got? What we've got is a commodity that nobody particularly likes, and that everybody is saying can't really go up very much, um, because of the ability to ramp up production or shale oil or insert the narrative of your choice. But from a technical point of view, what it's telling us is that it has huge potential. Now, I'm not saying that potential is going to be released next week, next month, or even in the next 6 months. All I'm saying here is that any move through the 72 to $75 area is going to open up a pathway to much higher values. That would be the technical chart playing out its potential. Okay, so oil is a market that we need to keep an eye on. I don't know what narrative is going to fall into place to justify oil going up. Um, I don't care because the story comes later. The chart comes first. The chart is suggesting what's coming already. I don't need to know what is going to be on well, over here in the UK, what's going to be on the BBC News, or over in the US, what's going to be on Fox News or NBC or CNBC or CNN or whatever. I don't care about that. So the story will no doubt fall into line as it always does, if this chart breaks to the upside. So it's a chart that we put on the back burner as a technical analyst. We're aware of the potential that it has, and we know the price level that if it passes through is going to enact those much higher values. Now, one other way of analyzing what might be going on in the oil market is to pick up a chart like the VanEck Oil Services ETF, OIH. And this is the sort of thing that we do for our website members, over and over again with a whole variety of different charts and different sectors, whether it's the uranium sector, gold and silver miners, energy, oil, whatever it is. But what you're looking for, if you remember that those gold and silver charts, you're looking for something that has been in a basing pattern, not doing very much for a long period of time. And that's exactly what this has been doing. It's been stuck in a initially in a downtrend, then it's been trying to recover. And when you're taking a position long term, you don't try and time the bottom, because just because something's oversold doesn't mean it can't stay oversold for a long time. So this might not have been the bottom. We know in hindsight that it was a very important low point, and it now looks like it was the bottom. But the price action has to prove to us that all of this mess under here is not going to be repeated. Because look, if you took a position in, let's say, 2022 at 230, you haven't really gone very far in the whole of 2022, 2023, 2024. In fact, in 2025, it dropped again. So your money's dead. You're not making any money here. It's not until the last couple of months that something really interesting has happened. And the market movers, the market participants, in other words, the price chart, which is the the aggregate of all market participants and what they know about the market, it's broken out above the 12-month moving average, above the 3-year moving average. If I put the 4-year moving average on here, it's broken out above that. It's broken out above the Ichimoku cloud, that's red and green technical indicator. And all bull markets are found above that green moving average and above the green Ichimoku cloud here. All bear markets are found below the green moving average and below the Ichimoku cloud. So we're now able to say that we're in a bullish environment for the VanEck Oil Services ETF. And if we get a monthly close in a few days' time that is above that red line, then it's done enough, technically speaking, to tell us that there's a much higher probability that this is going to track to the upside over the coming, let's say, 2, 3 years, than to break back down and plunge back into a bear market. It can turn down. I'm not saying it's impossible, but what you do with technical analysis is you um, become aware of the probabilities. The chart um, sort of unveils to you, it unravels, it displays the probabilities of future events. So by analyzing all of the weight of the evidence given by the price chart, you can determine the likelihood that we're entering a bull market or a bear market. And that's exactly what this chart is doing now. It's sending a signal by breaking through what we call an evidence cluster of evidence, the moving averages, the Ichimoku cloud, the downtrending red resistance line, the horizontal red resistance line. But it's broken above all of those through that cluster of evidence. And it's now giving a signal that we're moving from one previous set of conditions, which was not bullish, to a new set of conditions, which is bullish. And you can see the distance from moving average here. What's it done? It's broken out. This black line at the bottom is telling you how far the price is from that 3-year moving average. See the price is above that green line. Well, it's currently nearly 40% above the green line. So it's broken out from that downtrend. And it's also broken out through this horizontal resistance level on the distance from moving average. So there's a whole bunch of evidence on this chart that is telling us that the underlying conditions for that particular chart are very good. And you can look at other oil plays as well. Shell, Exxon, Whitecap Resources, and there are other energy and oil and gas plays that are displaying similar characteristics. And it's also worth remembering, of course, that oil and gas companies, producers, explorers, and so on, they don't need an oil bull market for the price to go up. They can be in a bull market going up and paying you dividends, even when the oil price is going absolutely nowhere. If you've got a stable oil price and costs come down, whether it's labor costs or energy costs or whatever, and the company is doing well, then you can be in a bull market for many of these companies, even if the price of oil isn't really doing anything very much. Or maybe it's the fact that the investors in the sector are piling into these stocks because they're aware of what's coming.
Mm.
How are they aware of what's coming? I neither know nor care. I don't care, you know, about any of that. I mean, all I care about is what the price chart is telling me. And the price chart isn't just a line on a chart. It's it's the investors. That line isn't arbitrary. That black line on the chart there is all of the investors, and it's the sum of their actions. And so clearly there are a lot of investors in the market that know a lot more than you and I ever will. So they tend to move the market more than the small players like me. So, so clearly, I mean that's statement to the obvious, isn't it? But when the price chart moves like that, it's not a line on the chart that's moving, it's the actions of the market participants that are moving. And so you have to take notice of that. So, a price chart can save you all of the fundamental analysis, can save you diving into the fundamentals of a company because it's literally displaying that for you in a simple format.
Yeah. So going back to your silver chart, so your chart was saying that silver is gonna near $50. There's gonna be a correction soon, you think?
I'm just going back to that silver chart now. Yeah. So we've already corrected something like 50%, was it, from $120 down to just over 60. So we had a correction of nearly 50% in price, but it happened so fast that I don't suppose many people had much of a chance to react to it. What's missing here is the time element. We've corrected in price, but we haven't corrected in time. Um, in order for the moving average, this distance from moving average indicator at the bottom, in order for that to become less historically stretched, clearly we need this green line, this moving average, to get closer to the price, and that's going to take time. It's going to take a period of time to allow that gap to close. So either the price kind of goes sideways for a while whilst the moving average catches up, or the price comes down to meet the moving average. And you can imagine in your on this chart just where they might meet, somewhere perhaps here where I've got it in June of this year, middle part of this year, maybe, and
Mm,
how long it takes to then consolidate and move up from there, time will tell. I'm not saying it has to do that. This is what would be ideal if you're looking, because most of us have got a position in gold and silver because we paid attention to the chart when it broke out at $28, and we know where the target is up here. So I'm only speaking for the people that haven't taken a position. None of, this correction doesn't matter. Everyone's focusing on the correction as though you have to use this correction to somehow get in at the bottom. That's wrong. That's not the right mindset. That's not how you do it. You either enter here when the chart gave the original signal, which is when we were telling all of our members that silver's breaking out down here. In fact, it's around $23. We got a buy signal. Um, that's the time to get in for the long term, and see the gains of 1,000% or more. But oh, clearly a lot of people ignored it, said it was ridiculous. Silver's never going to go above $50. Well, we now know that's wrong. So a lot of people are now coming to the market saying, when can I get in? When can I get in? Well, I'm sorry, you missed it. You missed the ideal entry point was back down here. I can't recreate that.
mm,
Okay, I cannot recreate that entry point, and I cannot recreate the entry point at $50. What I can say is that okay, you're late to it, but positioning any time here between 50 and where we are now in time is going to prove to be, I think, a wise decision. Not as wise as if you'd entered down there below 50, but nevertheless, when you see where we're going, and if you've got the patience, then it doesn't make a lot of difference. If you've got, say, you've got whether it's $10,000 or $100,000 or $1 million, whatever you want to invest, I would just suggest doing it in stages over the next few months, because that way, if the price goes up, you're at least establishing a position. And if the price goes down, then you're going to be dollar cost averaging in a falling market. Either way, when the price is heading up here, you're going to benefit from that. So trying to focus on the price pulling all the way back to $60 or less isn't really the way to view this. Yes, on the balance of probability, I do think that this year we're going to get a move down um, towards that $60 area over a period of time. We may go higher first. We may go back to the 120, 125 level. Perfectly possible. Could even go up to next Fibonacci extension levels up here, above 150, even $200. But I do think that we need a time-based correction that allows the moving average to come up. And, a low risk entry point can occur up here, even though there was a low risk entry point down here. So when I say low risk, I mean a low risk of being in a loss-making position during the next significant correction. So that was a low risk entry point. That's a low risk entry point at 50. The next low risk entry point could be higher. It could be up here somewhere. It could be at $120 because you've had a sideways move like that. The moving average is caught up and then you break out. So that's a low risk entry point, even though it's higher than where we are today. It's difficult for people to get their heads around that, but it's simple mathematical fact.
yeah, that makes sense. So going back to your gold chart, you say target one is $8,000. When do you think that will occur? When do you think gold will hit target one?
Well, I think roughly speaking, these target boxes are in the right place in terms of time. So is it, they're broad, wide targets, but when you're talking about long-term roadmaps, you can't say to the nearest month when it's going to take place. All we know is that target, but because we could get the correction starting and getting into a significant correction this year, you can imagine the price coming down potentially all the way to test the breakout, but seems a little bit unlikely. Let's say somewhere around 3,700 is perhaps a bit more possible. If it does that now, that's going to delay the time that we reach the target box, and it probably won't be until 2028. But of course, you can see the trajectory that we're moving up at the moment, and assuming the current upside move doesn't break on a weekly closing basis, then we could be there in the next sort of 3 months or so.
Wow.
So, there's a wide range of time. I doubt it's going to take until 2030 to get up there. I could probably make that target box a little bit more like that. Um, but we've got an 8-year cycle to think about as well. There's a low point in late 2015. So there's what looked like an early 8-year cycle low in 2022. So next one's due in around about 2029, 2030. So you could imagine going up into this target box over the next couple of years and then coming down into that low point in 2029, 2030, and then advancing up into the secondary target box in the early to mid 2030s. So that's the general sort of roadmap I think would be more likely. I mean, we could have a little bit of a correction here, but up into the target box, down into sort of 2030, and then advancing more strongly up into this target box. I mean, we may well overshoot that target box. Um, we may well end up having to readjust those targets higher. It wouldn't surprise me at all. But that type of, either straight into the target box and then down, or some sort of correction first. A lot of this depends on the stock market as well. If the stock market holds up and doesn't move into a correction, then I think it's probably more likely that we continue to track steadily to the upside. I think the next major drawdown in precious metals is likely when stock markets begin to roll over, and to what extent the stock market rolls over does remain to be seen. But the S&P, I can give you some levels if you're wanting something definite and actionable on this. The S&P is currently, I'll put this on the weekly time frame, is currently or has currently broken out of a very clearly identifiable rising wedge pattern. Okay. And when that happens, you can get a rapid upside move, a sort of a melt up move that takes place prior to the markets rolling over in a capital rotation event. So as long as let me phrase this in an easy to understand way. If we break above the green line, that melt up is taking place. So if we break above about 7,060, then the S&P should probably move somewhere to 8,100, 8,200. Okay. Um, if instead of breaking above the green line, we break below the orange line, somewhere in the region of 6,770, then the melt up scenario is taken off the table, and the much more likely trajectory is to test these double red support lines around 5,800. Now, at that point, that drop there, let me just measure it from the top to the bottom, will be less than 20%. And I don't think that's enough to qualify as a capital rotation event. The capital rotation process is taking place. All those boxes have turned red. So the capital rotation process is kind of done in terms of gold outperforming everything. The capital rotation event is when the stock market confirms that by falling, well, I would say more than 20%. I would say it needs to break these red lines here at the bottom. And you can only identify a capital rotation event in hindsight. You're not going to be sure it's the event as it's starting to unfold. It's only when it's broken below those red lines, and at that stage, everybody would be panicking and it'd be starting to fall quite quickly. At that stage, we would have the ability to say, yes, but this is the event, this is the capital rotation event. And you can have more than one event because in the last capital rotation event that favored gold in the 2000s, the stock market plunged twice. It plunged here in the year 2000 to 2002 by 50%, and then it recovered and it plunged again by 50% in 2008. So that was two events that took place in the whole capital rotation um, period. And that during this entire period, the stock market went nowhere. Gold went from $250 to $1,900. So it doubled and then it doubled again and then it doubled again. And the same thing happened in a slightly different way in the 1970s. And I suspect actually this might be what happens this time around, where you get a drop of, well, there's a small drop there of about 20%, then it recovered. And there's another drop here of about 35%. It recovered. And finally, there was a drop of about 50%. So over that entire period, the stock market went effectively nowhere. And gold went from, well, in 1973, the Bretton Woods Agreement was torn up, and gold went from wherever it was at the time, $30, $50, all the way up to over $800, I think it was. So, and silver went nuts as well. And the same thing in the 1930s, although we can't use gold in the 1930s to track the capital rotation because it was pegged, of course. We use silver instead. But one massive drop here in 1929, the market fell, I think it was over 80%. And then it, we had a big upside move again. The market then went up by 300%. So people would be thinking, great, the stock market's brilliant. It's gone up 300%. But between 1929 and 1958, it didn't make a new high. And during this whole period, even when it was recovering, silver massively outperformed commodities, energy, oil, all of those things. They went up by a hell of a lot more than 300%. So even during that recovery period, the stock market, even with its dividends, was not the place to be. And that's how things are during a capital rotation process or a capital rotation event. So that's what we're looking to identify using this weight of evidence.
Yeah, so from your charts, what do you think will outperform in the coming years, gold or silver?
Uh, well, at different times, they'll take it in turns. I think gold will outperform during corrective phases. I'll just turn my screen sharing off for a moment. But I think overall, from here to the peak, it's likely to be silver. Silver goes crazy on the recovery side after the stock market has fallen substantially, and precious metals probably getting caught up in that. When they start to recover, even as the stock market begins to go up, gold and silver massively outperform. But by that stage, the gold-silver ratio will have reset in favor of gold, allowing from that point onwards silver to massively outperform. So I suppose the short answer to the question is silver. And if you look at the miners as well, you'll be able to pick out a period in time where particular miners match or possibly outperform silver. But it's very difficult to find miners that will reliably outperform silver or gold and particularly silver during that phase when silver is going nuts. Um, for most investors, taking a core position in gold and a also a position in silver that you can vary the percentage of the amount that you have in silver during the course of the bull era, but having your core positions in the metal itself, and I'm not necessarily saying the physical metal, you can use GLD, SLV, there are a whole bunch of ETFs and funds that track silver and gold, or you can use companies like, well, I don't want to name companies, but there are companies where you can buy gold and silver digitally, and they store it for you, so you don't have the hassle of buying and selling it. So for a lot of investors, just doing that is going to be very, very profitable and a very good way of playing this if you don't want to make it complicated and you don't have the confidence to use trading platforms and buying and selling stocks and shares.
Yeah, so I wanted to get into uranium because I recently had a guest on that said uranium it's gonna be a bull market, it's really gonna go up, but I want to see what the charts say, so I wanted to get your thoughts on that.
Okay, all right. I'll share my screen and show you what's happening with uranium. Um, the Probably one of the best uranium miners is Cameco. Um, and certainly been a huge outperformer during this stage of the bull market. It broke out back in 2021, which was when I personally suggested people take a position, and it was down at about $12.50 at the time. It's now up at $115, having broken out again in 2023 above that resistance line there. Lots of volatility, and it scares people when the price falls by sort of 40% or more. But the evidence is strong to suggest that we're in a bull era for uranium stocks. And if we look at the URA ETF, and this roadmap, by the way, is one that I issued back in 2020. So it's 6 years now we've been following this roadmap for uranium. It was when we broke out here from this wedge and the price moved. Remember what I said, that when you find bull markets above the 3 year moving average, if I just put the line chart on there, you can see the black line there is above this green line. The green line is the 3 year moving average, and the black line is the price. Bull markets are found when the price is above the 3 year moving average and when you're above this red and green splodge, which is the Ichimoku cloud. So when we broke out through this evidence cluster in 2020 and 2021, I said we were transitioning into a bull era, not just a bull market, but a multi-year bull era for uranium. And we moved up from something like 11 or wherever it was on this ETF up to in excess of 30. And then we had a multi-year correction consolidation from which we broke out again. And that didn't particularly worry me because we'd sort of identified that this was a likely cup pattern. This geometric arc was expected to guide the price up to the target area in excess of $100. On the route to that, we've got this target area that when we broke out down here, sort of identifying the next target area in the region of $60. And of course, we've hit that, and we're now consolidating here. Now, if you're going to take a position in something, you want to be making sure that it's kind of the fastest horse in the race. And what I mean by that is, if you look at URA, this is URA, uranium miners priced in dollars that we've just been looking at. URA, by the way, is a uranium miner ETF. If we price it in gold instead and take a look at that, this is what, again, this is the type of thing that we track on a weekly basis for our website members there. But if we put this onto the monthly time frame, and we just get the chart so that it's easy to read. This is uranium miners versus gold. When the chart's going down, uranium miners are underperforming gold. When the chart's going up, uranium miners are outperforming gold. So there's that breakout in 2020 and 2021. And this chart was another reason why I was saying to everybody, that we were moving into a new bullish phase for uranium miners. They outperformed gold. And then since late 2021, the ratio's gone sideways. Well, it's gone slightly downwards, but generally speaking, it's gone sideways. So what we've said to our website members over the last couple of years is, yeah, Cameco's done great. It's outperformed, and we've made something like 600% profit on that one so far. And there are others that we're tracking making profits in as well. But generally speaking, if you're going to ask me, should I be taking position in uranium miners right now? I would say, well, you can do, but it's not until we break through the next evidence cluster that I'm going to be able to say that we're in a situation where the evidence is strong that uranium miners are going to be outperforming gold. And that's what you need if you want to be riding the fastest horse in the race. At the moment, since uh, late 2021, gold has performed as well as the uranium miner ETF, which includes a bunch of these uranium miners. And so when it breaks out, and the price of uranium, the metal, and the miners begin to outperform gold and gold miners, because we can also do the URA ETF priced in GDX, for example. And what do you see? Well, you see this arc pattern, which guided the price to the non-greedy target area pretty much. You can see up in this general area. But since then, the price, the ratio has gone sideways, and that arc pattern became ineffective at that point. So if I remove all the drawings, what you can see here now is that again, the uranium miners versus gold miners has gone again nowhere since 2021. So this is why over the last couple of years at least, we've not been suggesting taking large positions in uranium miners. We will do when this breaks out, because again, you've got an evidence cluster that is actionable. I'm just wanting to highlight that for you. It's in here. Passing through that red circle, you'll be breaking out above this black resistance line. You'll be breaking out above the 3-year moving average, and you'll be breaking out above the Ichimoku cloud. So at that point, the uranium miners would be sending a signal that for a period of time, we don't know how long, but for a period of time, they're going to be outperforming the gold miners. And you can also look at where significant resistance levels might be. Um, we've only got 2 touch points on that line. If we take it from here, again, you've only got 2 touches on that line. But there's probably a general area of resistance that lies in this kind of area here. There's a zone of resistance on that ratio chart um, in that area there. So what I suspect is that all of this actually is just a basing pattern for something much bigger that's going to take place. I wonder if we use URA versus ASA, because it has much more price history. ASA is a gold and precious metals index, and GDX follows it very closely. Doesn't really have much more. I think it's URA that has the limited price history actually. But anyway, this chart is the uranium miners versus ASA, which is the gold, mainly gold miners. And again, you can see that all of this really is probably just a basing pattern from which a breakout is likely to lead to much higher moves. So keeping an eye on this is going to be really important, because we don't want to miss this. The time to own uranium miners sort of broadly and having a large exposure to them isn't really now. It's when we get the evidence of this breakout. Yes, you'll have missed a little bit of the move, but the big move that you don't want to miss is above that black line. That's the price that you pay for using technical analysis and not just trying to guess where the bottom is. You could have tried to guess that that was the bottom there, but you would probably have had the same sort of guess here, and that wasn't the bottom. And for years and years, uranium miners underperformed, and even now we're still lower than we were in 2016. So the uranium miners now at a lower valuation priced in gold miners than they were in 2016. So the price that we pay is that we have to let the chart play out and rise. So the uranium miners are going to have to outperform the gold miners for a period of time before you get to that breakout point. And at that breakout point, that's where you go, right, okay, this is signaling a big move is coming, or is, if I use the right language, what I should say is that signifying that a big move is likely to take place. Because again, as I said, it's all about probabilities. And you can see the size of that move there, actually. So on a breakout, you're likely to get a measured move like that, which interestingly takes you back to that level that we're at in 2011 there. So hopefully people watching this can see that technical analysis, it doesn't get you in at the very bottom, it doesn't get you in at the very top. Some people are probably going to go in the comments and argue that there are ways of doing that, but I'm afraid oversold can become much more oversold. So you can never be certain that the bottom is in. But what you can be confident about is breaking through these clusters of evidence is greatly increasing the probability that the trajectory for the next 1, 2, 3 years is going to be to the upside, and that's what you want as a trader and investor.
Yeah, thank you for that analysis. I wanted to take the time to share my screen to show Kevin's X account and Northstar charts. Would you like to tell the viewers a little bit about your X account?
Yeah, sure. I mean, on X there, you'll find a steady kind of commentary on gold and silver and cryptocurrencies and oil and all that sort of thing. I'll put my big picture charts on there that give, big picture roadmap of where we're likely to be going, what the odds are suggesting. When it comes to specific trades that include the entry point, the profit limit, and the stop loss, if you're wanting trades in the oil sector, in the uranium sector, in gold and silver miners. If you want to learn more about charting, if you find all this quite sort of interesting, and you want to learn more, then our website contains something called a knowledge base. So we don't just want to give you trades to blindly follow. We'd like people to understand how to do this for yourself. So we've got a lot of training material on there that you can follow and learn how to do this, for yourself. So and you can join the website if you don't like it. You can cancel within 7 days, get all of your money back there. It's no problem. And for anybody that's watching this, if you use the discount code NSBC Lifetime 50, then viewers of this channel will get a 50% discount. So that's that. And then we also got a YouTube channel there, which we don't use quite so much, I'll be honest, but we when we interview high profile people, like we've got an interview there that we did just recently there with Luke Roman. Um, was very popular, and Luke's a great guy with a lot of years of experience. When we do interviews like that, we'll put those on our YouTube channel, and that's all publicly available. We have a hidden YouTube channel which is accessible only to website members, and that's why we post all of our detailed analysis on things like oil and uranium and cryptocurrencies and all that kind of stuff. But our publicly available material gives you a good flavor of who we are, what we do, and how we do it. And if you want to know more, as I say, just go to the website.
Yeah, that's definitely great. I encourage everyone to check out his YouTube channel, his X account, and follow him on X and check out his website. And is there anything else you'd like to add in this video, Kevin?
Not really. There are plenty of public reviews out there. If you go to Trustpilot and Google reviews, so if you think who is this guy? Sounds okay, but he might be a charlatan, snake oil salesman. My background is in forecasting, military aviation forecasting. So I've got a sort of a series of techniques that we used in meteorological forecasting and a methodology that we apply to forecasting stocks and shares and gold and silver and all that kind of thing. So it's not just kind of sticking my finger in the air and kind of drawing a few squiggly lines on the chart. There's a technique to this. There's a scientific technique to it. So hopefully over time people will, I don't know, begin to understand that. But as I say, those reviews are there. Read the reviews, see what other people think. Our website members are free to say whatever they like about us, good, bad, or indifferent. And open and honest is the only way to do it.
I definitely agree, and I'd just like to thank you again, Kevin, for coming back on the show, and we would definitely like you to come back on again in the future.
That'd be great, Alexander. I really appreciate that. Thanks a lot.
And thank you all to the viewers who are watching. Please share this video with all your friends and leave a like on the video. And thanks again. I hope you all have a good day.